What's going on, everyone? This is Gaurav and welcome to my learning channel. So in this video, we're going to talk about what is a balance sheet, why do we need it, and what are some of its components. Now, I promise that I will try to follow a very common sense approach to explain this, so hopefully it's not too boring. So a balance sheet is a financial statement which tells us what is the financial condition of an organization on a given day. So this tool gives you all the required information which can help you understand the financial condition of an organization as a snapshot in time. So it's really important to understand and remember that there is a snapshot in time component whenever we talk about balance sheet. So status as of a certain date, then you can say that balance sheet is probably your best friend. However, performance over a period of time, then balance sheet is pretty much useless. Then in that case, you will have to use some of the other financial statements like income statement. Okay, so now let's think intuitively for a minute. Let's just say that somebody gives you all the data that you need from an organization and asks you to assess its financial health. What are some of the important key questions you would ask? Few of the questions that come to my mind is that first one, what does this firm have in terms of how much money does this firm have? What are the different type of assets that this firm have? And second one is, where did they get all of this from? Now, of course, there could be like a lot of similar questions, but at least these two questions are very fundamental and foundation in nature. Now, if things are calculated properly, then the two of the items, which is what does this firm have and where did they get it from, should ideally be equal. It's like energy. It cannot be created, cannot be destroyed, it only changes its form. Anyway, so coming back to the topic. So in case you look at the balance sheet, you would see that there is no section for what do I have. Rather, you will see that there is a section for asset. Like way to complicate things, right? So your asset is in a way is what you have. And let's just say that this is the left-hand side of your balance sheet. And then on the other side, which is the right-hand side, is your total liability and shareholders equity, which is in a way telling you that where did I get it from. So in an ideal world, as we discussed earlier, your left-hand side should be equal to your right-hand side. Now let's double click on each of the three items to gain a better understanding. The first one is asset. Now as the name suggests, asset is what I have and it would represent the things that we have that we are going to use in the future for a value creation. So let's take an example to better understand this. Let's say you are an owner of a lemonade stand. So in that case, your table, your lemonade machine, in case you're using one, is your asset because it would help you generate a value in form of cash in the future. Now in terms of accounting, an asset will have three important properties. Now, it's really important that all of these three properties should be present for you to call anything as an asset. The first one is that it should have some probable future value. So it's totally fine if you don't know exact value of this particular item, let's say the table in your lemonade stand in the future, but as long as it has some value in the future, as per your understanding, then you can call that as an asset. The second one is that it should be under your control. So in this particular example, as an owner for your lemonade stand, the table is of course under your control. Nobody else can take in. That's why it is an asset. So let's take a counter example as well to better understand this. So you might actually think that as a citizen of a particular country, I own this country. So everything in this country is mine. So that light stand over there is also something that I own. But you cannot call this really an asset because it's not under your control. Honestly speaking, government controls it. You don't have the full control. That's why you cannot call it an asset. And third one is that it should come from a past transaction. So it shouldn't be that you're treating some future transaction as a value generating asset. The transaction must have happened in the past, which help you get the asset. So unless all of these three conditions are satisfied, you cannot call something as an asset. Now, hopefully this would have given you a good idea about what is an asset. Now let's take a look at liabilities. So liabilities have a very similar definition as your assets. So liabilities are the future values which we are going to have to give to an outsider. So in essence, it is what do we owe to others. So for example, let's say that you buy a car for your business and don't pay the entire cost, but rather take it on a loan. So that loan would be your liability. Just like asset, liability will also have some basic principles. So first one is it should have some probable future economic sacrifice. So you see, even here, just like asset, there is a probable angle. So even if you're not 100% certain whether there's going to be some sacrifice that is needed to be done in the future, as long as there is a probable angle, you would have to call that as a liability. And second one is just like asset, it should be a product of your past transactions. So as a part of liability, both of these properties should be satisfied. So hopefully this would have given you a good idea about what is a liability. Now let's take a look at the third and the last item, which is shareholders equity. Now this is a little bit complicated to understand. So equity represents the value that was directly contributed by the owners or created over time, but not yet distributed to the owners. So this is not very clear, right? I mean, at this point in time, they might be thinking, well, asset and liability kind of makes sense. One is what you own, which is your asset. And the other one is what do I owe to others, which is your liability. So what the heck is shareholders equity? Okay, so let's try to understand this in a slightly different way. Apart from the dictionary definition, you see balance sheet actually follows a very simple mathematical formula, which is asset is equal to liability plus equity. So equity is equal to asset minus liability. So if I have to write this in a plain simple English, I would say that equity is what we are left with once we remove what we owe from what you own. Does that make sense? See, I told you I will explain it in a very common sense language. Alright, so in a way, you can say that after I fulfill all my obligations, what I am left with is what belongs to my shareholders. And this is why we use terms like residual or book value of the firm to define equity. Okay, so these were the three components of a balance sheet. Hopefully, this video would have given you a good idea about what is a balance sheet and what are its components. Okay, so in our next video, we'll continue to build on our accounting principles. Until then, I wish you best of the luck and thank you so much for watching my video. Hey, and please don't forget to like and subscribe.